Good afternoon or good morning, depending where you are, and a very warm welcome to our latest webinar. Infinity Financial Solutions are delighted to welcome the team from Tilney to have a market outlook. This is the next in our quarterly series. I was talking to the Tilney team and they pointed out it's almost a year to the day since we started these. So a very warm welcome to everyone. The presentation should last around 45 minutes, I believe, and then we will be following it with questions and answers. We have had some Q&A submitted via email, which we will pose to the team and the panel. And additionally, you should have a Q&A box at the bottom of your screen or somewhere on your screen, depending on your computer setup. Please feel free to drop any questions into the Q&A rather than the chat box, and we will be happy to get them answered for you. We will do our best to finish succinctly within an hour, but it does depend on the questions. So without further ado, I'm going to hand over to Harriet. Harriet will give a brief introduction, and then I believe that Gareth will take over the presentation. Thank you all, and I'll see you at the end.
Thank you, Trevor. Good morning all, or good afternoon to you all, and good morning from quite a grey London. Thank you for joining us for our first quarterly update of 2021. As Trevor has said, it is actually a year to the exact date that we did our first webinar with you guys. I don't think any of us thought we'd still be sitting here working from home, hosting online presentations rather than actually seeing you in person a year later, but we are here, and hopefully we can see some light at the end of the tunnel, and hopefully a visit in person might be on the cards later this year, but keeping our fingers crossed. Before we begin, I've just got to ask you to read some very important information, so if Gareth could just pop onto the next slide. It's got to be on there for compliance purposes, so I'll let you read that. Before we slip onto the next slide, I think many of you know who Tilney are. Many of you have listened to our presentations before and met us in person, but for those of you who don't and are joining us for the first time, Tilney is one of the UK's leading wealth management firms, providing investment management solutions to clients like yourselves for over 180 years. We have just over $60 billion of assets under management, with over 1,000 staff throughout the UK, and dedicated teams of sector specialists, analysts looking at those underlying investments that we use to build the portfolios that you invest into. We've been working with Infinity since 2012. Tilney provides the investment management solutions alongside the holistic financial planning that Infinity offer. This morning, as Trevor said, we'll be talking for around about 45 minutes with an opportunity for questions at the end. I'm joined by Gareth Lewis, our Head of Investment Strategy at Tilney, who's talking about views coming into this year, looking at the response to the pandemic, fears over rising inflation and also the bond market. And then he will hand over to Lewis Cohen, our Investment Director at Tilney, who will talk through how those macro views have been reflected in your portfolios, and take a closer look at how some of the underlying companies work, but we'll take a closer look at some of the underlying companies that we invest into. So without further ado, I'll hand over to Gareth, and I'll probably speak to you at the end.
Well, thank you, Harriet and Trevor, and good afternoon to all joining the call, and to my colleagues in London, good morning. So I think, as Trevor and Harriet have highlighted already, the purpose of the session today is to give an overview of our current thoughts on the global economic situation, and to touch on some of the issues we think that are coming out of the situation that we need to be aware of going forward. The presentation I'll give will be broadly split into two sections. The first will be a little bit of a synopsis of what happened last year, but only very briefly, really focusing on the main drivers of the recovery in asset prices that we've seen. And then moving on into the second section, which will really focus a little bit more on some of the consequences of that recovery and some of the things that are now beginning to cause us a little bit of concern around some of what may happen next, certainly in 2022 and 2023. And I think one of the big issues that we need to all be aware of is that 2020 marked a very material change. And to us, that change was really the first significant change that we will have seen since the global financial crisis in 2008. So if we go back to 2008 and the subsequent 12 years, policy on a global basis has largely been set by central banks. It's been the response of central banks to the banking crisis and to the sluggish economic growth that parts of the world have experienced that have really set the backdrop for all of the investment decisions that we as professionals and you as private investors are making. And that's changing, and it's changing because of the way in which governments have been forced to respond to the COVID crisis and the way in which they have shifted policy response away from just looking at macroeconomics, but really now looking at some of the social consequences. So our views going into the beginning of this year were very much that we felt that the COVID crisis really marked this first change in the way in which the policy debate would be shaped, that the policies that have been required by governments and central banks to backstop capital markets and the rally we've seen in asset prices will start to focus attention much more closely on the unequal distribution of wealth that's taken place since the global financial crisis. And that the driving force behind that would be very much focused on the US, where the Biden presidential election victory at the end of last year and his subsequent appointment of Janet Yellen as Treasury Secretary has started to shift the way in which the world's arguably largest economy is dealing with some of the consequences that came out of the GFC. And as a result of this, we would expect to see significantly higher levels of fiscal spending, and we've already started to see that announced. Almost certainly greater tolerance for above target inflation, and that those two things were likely to unsettle bond markets and create equity market volatility. But while investors were comfortable with the situation and the positioning of central banks, that hiatus that you would likely to see would probably be temporary because economic growth would accelerate, monetary policy would remain accommodative. But some of the style rotation we've started to see that's devolved from this probably is relatively short term. And I know that some of you have been asking questions specifically about the UK equity market and equity market performance. So we'll come on to that as part of this presentation. So that's just a little bit of a backdrop. So why did global equity markets and risk assets generally recover very sharply last year? Well, obviously, we're all very well aware of the central bank story of monetary expansion. And the slide in front of you simply gives you a potted history of central bank balance sheet expansion really since the global financial crisis. And the important aspect to this is to understand that central banks over the last 10 or 12 years have really been the backstop to the global economy. They've used quantitative easing initially to support a global banking system that was fundamentally unstable. Arguably, it was economically unviable going into 2009. But that use of QE has morphed and it's changed into a sort of catch-all response to economic crises. The way in which the Bank of England responded to the Brexit vote in 2016, for example, was a classic response where central banks saw a particularly destabilizing event and pumped more money into the system. And this has become a default. But if you put the response of the last 12 months into the context of the previous 12 years, as this chart shows, you can see the magnitude of that response. And if you just look at the blue line, the US Federal Reserve, the Fed's balance sheet had been slowly tapering off from about 4.5 trillion at its peak in 2015 to around 4 trillion going into COVID. It's now up over 7 trillion, and the forecasts are for this to grow to around $9.5 trillion by the time the current rounds of QE have finished. And that magnitude of stimulus is genuinely unprecedented. It's had a huge impact on the way in which asset prices have behaved, but it's the connectivity between the central bank's response and what governments are doing that actually marks the change as we move forward. So if you look at the way in which asset prices have behaved, you can see on the next chart the very clear relationship that exists between central bank balance sheet assets and global equities. There can be no doubt that a relationship exists between the two. The nature of that relationship is relatively complex, but at its simplest form, an awful lot of the access to cheap capital that has been made available to the corporate sector through QE has been used by corporates to borrow significant amounts of money in bond markets and to use that money to buy back their own shares or to buy other businesses. And this has helped to propel asset prices higher. In addition, keeping interest rates at a very, very low level has inflated the valuation of very high growth businesses. And that's one of the stories, I think, for this year, as maybe that starts to unwind. But the relationship exists. Investors are very much invested in the perpetuation of this relationship, that, you know, QE is good and it's good for asset prices. And I'm not so sure that that relationship will carry on going forward. And it's something that we need to be very aware of as we move through the rest of this year. And the reason I think that we have to question that relationship is the fiscal aspect of this. So, you know, I said at the top of the presentation, 2008 onwards was very much a monetary policy story. We are now in a fiscal policy story. A lot of the central bank balance sheet expansion we've seen has been used to directly fund government spending commitments. Much of that is to do with the furlough schemes, supporting businesses through a global lockdown. But it's also becoming much more a weapon of social change. So politicians effectively being given access to vast amounts of liquidity by central banks are directing that fiscal spending to address many of the social consequences that we've seen over the last 10 or 12 years. There's a much greater emphasis on employment, there's much greater emphasis on wages than we have seen in the last 12 years. And this is beginning to change the way in which the global economy is behaving and will react. Now, one of the things that people may dispute is whether there is a social aspect to what's going on. What people can't dispute is the impact on the economy. The most recent estimates for global economic growth are on the chart in front of you from the OECD. The green bars highlight the most significant changes when they announced their March forecasts over their December forecasts. And what you can see here is a material increase in growth expectations over the last 3 months. You know, world GDP is currently forecast to be around 5.6% for the current year, with significant growth in many of the developed Western economies, notably outside of Europe. So the growth is largely coming from the US, is coming from parts of North America, Australia, it's coming from the UK, but it's not coming from continental Europe, where, you know, the slower vaccination program and the perpetuation of the infection rates is beginning to have an impact. The other thing I think it's worth noting from this chart is the China line. You know, China's growth rate or recovery from the COVID crisis. You know, obviously China was first in and first out of this, and last year was a very strong economic year for China relative to much of the rest of the world. But as the Chinese authorities are trying to rein in some of the excess credit consumption that's driven that recovery in China, you are starting to see Chinese economic growth rates slightly decline, not in a material way. But if you then look to 2022, what you can see is that the recovery we're seeing this year is not really sustained into next year, that the pattern remains broadly the same as it was before, but at lower rates. And you can see how, for example, China reverts back to pre-COVID growth rates of GDP. And so one of the big, I think, unknown questions for us and for investors is whether the changes in policy we're seeing in the US and China will offset one another as we go into 2022 and 2023, and the global economy reverts back to a more normal pattern of expansion than the one we're going to see this year. But one of the consequences of a combination of central bank balance sheet expansion, aggressive governmental fiscal policy, and this sort of insignificant increase, particularly in the US, on infrastructure spending, has been the market's shift in perception around inflation and around bond yields. And this is probably the biggest single event that devolves from COVID. And it's important to put a little bit of context around this. So, back in 2007, 2008, as the banking crisis hit and we saw the first rounds of QE being announced by the Fed, many market participants felt that quantitative easing in its own right was inflationary. And it's back at that period when the UK 10-year gilt yield was about 4 and a bit percent. That one investment bank analyst described a gilt as a return-free instrument of risk. Subsequently, obviously, that yield has fallen to effectively zero. So that was a materially wrong call. But there was a general perception that QE was pro-growth, pro-inflation. What at the time people didn't fully understand was that QE was an equal and opposite offset to the deflationary consequences of banking sector insolvency. So we never really saw the material increase in inflation that many people expected. And as I've already explained, a lot of that QE then got trapped into financial assets through this sort of circularity of bond issuance, share buybacks, and corporate merger and acquisition. Now, the trouble is that when we talk about inflation, we talk about inflation in the sort of official government measured value of CPI or RPI, whichever data series that governments focus in on. And in that sense, you can clearly see that QE did not create official CPI inflation. But what you also can't deny, if you think back to the chart that showed the MSCI World Equity Index, is that QE created significant levels of asset price inflation. And this is where I think things start to change, because as central bank QE morphs into fiscal spending, it seems increasingly likely to us that asset price inflation now morphs into wider global inflation. Now, this isn't to say that inflation will become unmanageable, certainly not. But what it does mean is that the relatively benign low inflationary backdrop that we have all become very used to is likely to change underneath us incrementally, and possibly in a way that we don't really even notice as it's happening. And one of the reasons I think that this will happen is because central banks themselves are changing. They're responding to COVID, not just by printing money, but in ways that change their outlook from policy. So, if you look at the way in which central banks have removed their forward guidance on interest rate expectations, they're clearly trying not to mislead markets. They're putting much greater emphasis on employment levels. This is coming back to the sort of social aspects of policy rather than in inflation. And it's quite clear that many central bankers, particularly in the West, are quite comfortable with allowing economies to run hot in order to reach full employment and create a rising wage backdrop. And I think this ultimately suggests that there is a subtle change in the way in which central banks view asset markets, and we just need to be aware of that. Now, the reason why so many market participants are fretting about inflation is where a lot of the QE has ended up through last year. Much of it has been reflected in this very significant increase in US broad money supply, over $3.6 trillion increase during the first half of last year, and that has carried on since. That is sort of spending power on the sidelines, and it's quite probable that that broad money supply over time will feed out into the wider economy. If you start to see inflation pick up, it also seems likely that banks will increase their lending, because in a very low inflation environment, holding cash or quasi-cash type instruments on balance sheets doesn't cost them much. As soon as that shifts, they will start to deploy their balance sheet strength, and many banks are very strong from a balance sheet perspective, and that's where the velocity of money starts to pick up. And it's that increase in velocity that has been one of the things that's been missing from the last 12 years. And you can also see that the way in which banks have held this cash on deposit at the US Treasury has built up materially. And this is the sort of banking firepower that sits behind certainly the US economy that could and is almost certain to be unleashed as economic prospects improve and as inflation picks up. Now, you can see the way in which markets have responded to this. So the chart in front of you shows you the expectation of inflation in the US. It's taken from the US 5-year inflation break-even rates. But what effectively this chart is telling you is a combination of vaccine plus QE plus fiscal stimulus equals raised inflation expectations. And you can see the sort of two phases in this chart. You can see the absolute collapse in inflation expectations linked directly to COVID in March, that bottomed almost exactly at the end of March. You can see the short and very stuttery recovery that's linked to the first rounds of QE and the lockdowns, which people thought probably would ease the spread of the infections. But then this incremental acceleration through the first phase, which was the expectation of slightly more normalized economic activity. But then the second phase from November onwards is clearly vaccine linked. From the point at which the announcements of effective vaccines were coming out, the combination of the perception of a return to normality with all of this fiscal stimulus, all of this QE, has led to a material rebound in inflation expectations. And so as we sit here today, current US inflation expectations are now significantly higher than they were through most of the 18-month, 2-year period prior to COVID. So this is a significant change in market expectation. Now, that is a very dangerous sea change, because global bond markets have been effectively in a 30+ year bull market. Chart in front of you simply shows the yield on the 10-year UK gilt from 1989 through to today. You can see the peak on this chart, nearly 13% back in 1989. In fact, the 10-year gilt yield peaked in 1980 at just over 15%. And although it's been a bumpy journey along the way, gilt yields and inflation expectations have been in a 40-year period of decline. And for many market participants, that takes them back to a period when, literally very few people currently investing money in the world anywhere will have worked in an environment where bond yields are at risk of rising. That the backdrop for investment has been consistently lower yields, consistently lower inflation, and therefore a consistently benign backdrop for equities as well. And so we need to be aware of the fact that if this inflation expectation changes and becomes embedded and bond yields become less stable, then this is a structural shift in the backdrop to most of what everyone is doing. And just to show how dangerous even small changes in yields can be when yields are this low, the 30-year US Treasury bonds yield has risen about 70 basis points to about 2.6%. So, in absolute terms, this is a very, very small increase. But in terms of capital, the 30-year US Treasury bond has actually lost 14% of its capital value through this year alone. And that is being replicated across lots of other bond markets. So just to put that into some context, the chart in front of you shows you where the Q1 2021 stands in terms of the worst periods for long-dated bond markets, in this case US Treasuries. And it's actually the second worst in 40 years. The worst was Q1 1980. Only just worse than it is now. And so you can see the magnitude of the drawdowns that have been experienced in bond markets this year has been, by most people's working experiences, unprecedented. And it's quite telling there are only 2 periods in the post-global financial crisis that actually register on here. So that's a little bit of the backdrop on bonds. Now, what has happened as a consequence of this shift in bond yields has been a change of rotation in terms of equity market leadership. It's been very well debated and signposted in the press, so everyone's pretty much aware of this. But really, from halfway through the first quarter of this year, the sort of appreciation in value stocks globally, which had been going hand in hand with the recovery in growth stocks, started to diverge. And value stocks generally continue to perform very strongly, whereas growth stocks actually have slightly derated. I mean, they've not really lost you any money, from the turning point, but they certainly haven't kept touch with value stocks. Now, this is largely a positioning piece around not just the valuation of these businesses, which look cheap, but this embedding of expectations around structurally higher economic growth and structurally higher inflation. So for this trend to continue, you would expect and hope to see further increases in GDP estimates. You'd expect to see further inflationary expectations embedded in, and probably, and slightly more worrying in the background, greater instability in bond markets as well. Now, the thing about the value rotation is that it's partly to do with value, but it is a lot to do with credit quality. Now, I apologize for these two charts. They're incredibly busy and quite unpleasant to read. But the big thing here, and there is a parallel between now and 2009, is that the stocks that are increasing in value most rapidly at the moment are those that fell the most during March of last year, as you would expect. So it's the lowest credit quality. So you can see on the right-hand side of the two tables here, the purple line, the single B credits, the lowest quality credit really that you can invest in, has been by far the most robust indicator of future growth in share prices. And this is partly because these businesses were actually priced to fail at the trough of the markets back in March. And as policy responses kicked in and now economic responses have kicked in, then the chances of these businesses failing in the short term, at least, appears to have diminished or fallen away completely. And you get this rapid recovery. It doesn't necessarily mean it's sustainable. And it certainly doesn't necessarily mean that it's qualitatively driven, but it is an understandable response. And it's very similar to the way in which global stock markets responded from March 2009, when the post-March 09 rally was very much linked to the lowest credit quality businesses, many of whom share prices rallied very aggressively, some of which still subsequently failed. So we just need to be aware of that. Now, the thing that we need to bear in mind, when we're talking about inflation and growth rates, and I touched on it when we were looking at the OECD chart, is that this is not a universal story. The vaccine rollout is really quite uneven. And so the response in terms of bond markets has also been uneven. So, we're very aware in the UK, for example, how fortunate we have been in terms of the speed of the rollout, the ability of the government to source vaccines, and frankly, the infrastructure that the NHS has created in the UK has given a structural model by which the vaccines can be rolled out. And so the UK has actually been at the very forefront of vaccine rollout, whereas Europe, for example, has not been. And not only has there been issues about supply, there's been issues around the way in which they're being rolled out. And you can see this play out in the bond markets, which is the bit on the right-hand side. And see how the UK bond markets have performed much worse than those in Europe, where the expectations of economic recovery are much lower. So the worries about inflation are therefore much lower, and therefore bond market falls, although they have fallen, have not been of the magnitude you've seen elsewhere. So you just need to be aware that the world remains quite skewed at the moment into the have vaccines and to those that have not vaccines. And that probably makes for a more volatile outlook over the next couple of years as these things ebb and flow. So if we start to think about what may happen next, I think we need to be very aware of the fact that although asset prices have recovered and the short-term economic outlook certainly looks very positive, that the world remains far from normal. And a lot of the structural instabilities that have been built up post-global financial crisis have actually accelerated over the last 12 months, but they've been buried under a vast weight of money. And one of the key things here that we need to be aware of is to do with defaults. So, one of the weird outcomes of the global financial crisis, one of the worst crises the world has seen since the 30s, actually experienced relatively low levels of corporate default because of the way banks and governments responded back then. this time round has been even more remarkable. So I just picked up this chart from the IMF quarterly report, and I think it's very telling. The only thing you really need to look at is the position of the three lines relative to the baseline of 100. What this is showing you is the corporate failures through recessions. And the red line you can see is the global financial crisis, and you can see the rapid increase in global business failure that resulted from the global financial crisis, but the equally rapid decline back to what was a quite abnormal period. You would have expected those defaults to accelerate rather than decline. The yellow line is just other general recessions, and you can see this more incremental increase in business failure as the recession deepens. Businesses that are kept afloat for a period of time ultimately fail, and you get this sort of acceleration in business failure. The blue line, on the other hand, is the COVID crisis. And actually, the number of businesses that have failed post-COVID is lower today than it is in a normal expanding economic environment. So the blue line to the left. And that is unprecedented. You know, there have been very few businesses fail as a result of what's happened. This doesn't mean to say they won't fail, and it doesn't mean to say, unfortunately, they shouldn't fail. What it does tell you is that policy response, particularly fiscal response, and the way governments have behaved, has backstopped businesses today that will not be around tomorrow. And so a lot of what we're seeing at the moment is an abnormal recovery that hides a lot of the longer term and unpleasant truths from us. And why do we think that will happen? Well, I've shown you this chart before, but quite clearly, if you've got higher levels of global indebtedness, which we're all aware of, the response to the crisis has been to take on more debt. But if that debt and the cost of that debt starts to go up as bond yields rise, then it is likely that you will start to see greater stress, irrespective of the backdrop of the COVID lockdowns and the fact that we haven't had business failures so far. And we've started to see, a lot of listed businesses significantly increasing debt issuance to shore up balance sheets. So quite prudently locking in very low interest rates, which has been, businesses that were raising capital in Q4 last year have locked in lower rates than if you did the deals today. And they've also been locking in longer duration. So what they're basically saying is they feel that the trough in global interest rates has passed. They want to lock in as much capital as they can at low rates for a long period, because it staves off the day when they have to ultimately refinance again. And I think that's a telling story about the way in which the CFOs in the corporate sector are actually viewing the current recovery. So what I'll do now is pass on to Lewis, who will take you through some of the things we've been doing as a result of that analysis. And then I'll rejoin you at the end for Q&A.
Thank you, Gareth, for that. And hello, everybody, and welcome to the webinar. So Gareth's macro view obviously has quite a lot of influence on how we are implementing policy changes and inflation expectations into our portfolios, and therefore by default into your portfolios. So just on this slide, you can just see some of the things that we are considering, and that we are looking at this market recovery through the cyclical rotation. Our expectations in 2021 are definitely supportive of that. But there is that risk that inflation expectations could start to raise the cost of capital. And I'm just going to show a few slides as to how that has impacted us on our positioning. So if we can just, if I just show you on the next slide and look at how we do it and why the view of inflation is so important. If we just sort of think back to the slide that Gareth showed with that broad money supply, well, you can see that there's been a significant increase in household deposits. Obviously, with inflation expectations rising, that reduces the value of current money, and therefore we should expect some of that redistribution from savings into expenditure. Those are some of the more negative nuances, but actually, on a more slightly positive note, inflation can actually also be a sign of rising demand on back of the consequences of economic growth. And From a government perspective and from a wealth perspective, you'll see in the chart on the right-hand side, what one should bear in mind that once inflation expectations start to set in, they're very unusually reversed. So they do stick. But from a government perspective, higher inflation can lead to fiscal drag. That's really important because it's a very easy way for governments to reduce the burden of their debt without having to increase significant tax regimes. Although, as we've seen in the news through the Biden-Yellen proposals, there is a move to increase the sort of flat rate of tax in the US. But when we do have that increased consumption as a result of changing from savings to expenditure, obviously the tax take then rises as a natural default for indirect taxation, and that also raises corporate profitability, and therefore you see that sort of nicely sort of circular route into corporate strength. On the flip side of that, and I'm going to come on to equity markets, but just staying with bonds for the moment, and on this slide, what you'll see is that by having inflation, if we just sort of flip it forward one, please. Hopefully this the slide will move. But the increased of inflation, thank you, removes the diversification benefits of the bonds, and Gareth's talked about that. But what is really relevant is that we use bonds in our portfolios of fixed income as one of the dampeners to volatility, of course, but we've seen increased volatility as a result of these inflation expectations. It's really, really sort of highly highlighted here that you can see that the real rate or nominal rate turns negative once the nominal yield is less than the rate of inflation. That is normally accompanied by higher central bank rates, although as Gareth mentioned, that may not be something that we have to worry about in the immediate future, but is something we may have to consider down the track. But really what that tells us though is that obviously at the longer end of the spectrum, if there is an expectation of higher interest rates, then that has a negative impact on the current bond yields. And so what you find is that coupons start to look very unattractive because you've got longer dated coupons with a higher rate. Keeping duration at a minimum is therefore integral in our portfolios. One of the alternatives to that is that we do use is inflation linked bonds. Of course, those coupons are linked to a particular inflation rate, but the payoff is that payments tend to be lower than would be traditionally available on our bonds that we would normally buy. So with that in mind, what it does do is it does emphasize the long-term attraction of equities, as this next slide will show you. And we know that equities are sort of driven, or returns are driven by two factors: corporate earnings and the multiples that investors are prepared to pay for those earnings. And what this chart is really demonstrating is that cyclically adjusted price earnings sort of ratios and how expectations are changing. And as inflation expectations increase, as we believe that they are, then in reality, an active investor should be the one to make the most profit from that. Because in the longer term, as we've talked about previously, equities have often been a good investment relative to inflation over the very long term, because companies can raise prices for their products when their costs increase in an inflationary environment. However, it's only available for those quality businesses that we look for. So when you have quality companies who are able to make higher profits because they have the ability to increase prices easily, even when demand is flat and capacity is not fully utilized, or they have less fear of significant loss of market share, or they have the ability to accommodate larger volume increases in business, which is often produced more by inflation than growth, then they only need a minor adjustment in their investment of capital. And that's really what is fundamental to how we construct our portfolios, because when we look at our portfolios and we reflect those macro views at portfolio level, what you'll see on this next slide is some of those businesses that we're looking through and how we're positioning. So just before I go into sort of some of the underlying companies, two of the things that we've done over the last quarter in line with our thinking is that we have been reducing bond duration. One of the ways to protect capital is to reduce the duration to maturity in our bond portfolio. That takes out an element of volatility because you're less aligned to movements in interest rates. And we've also been adding to our equity positions from some of those sort of sales. I've been into cash, but a bit back into global equity. In the global equity space, what we've also done is some slight changes where we've taken profits in our holding in Morgan Stanley US Advantage. The reason for that is, although it's done spectacularly well over the last 12 months, it has a significantly large exposure to global technology, and we have quite a good weighting to global technology within our other fund managers. What we want to then do is look at the sort of long-term ability of businesses to grow earnings and free cash, and that's why we've added to the funds that we have the most strongest sort of confidence in those fund managers. And then if we take that through to the next stage, what you can see on this slide is actually some of those businesses that we've, on a look-through basis, that we are invested in. Now, all of these companies, we have an inherent belief that they have the ability to focus on long-term growth of earnings and free cash flow. A lot of those names in there you're very familiar with, but I thought today I would just highlight just two ones that you may be less familiar with. So the first one is EssilorLuxottica. This is a French company, one of the leading groups in the design and production of lenses, optical equipment, prescription glasses, etc., and sunglasses. And it owns a significant portfolio of proprietary and licensed brands. And for those of you who may own Ray-Bans or Oakley sunglasses, for instance, this is the company that's making them for you. So again, it just shows the distribution of earnings. And then finally, just the one that you may be more familiar with in Southeast Asia is Yum China Holdings Incorporated. So this is actually listed in the US stock market. It's a Fortune 500 company, fast food restaurants globally, several subsidiary brands, which include KFC, Taco Bell, Pizza Hut, that you will probably be a bit more familiar with, but also Little Sheep, which I believe those of you across Pan Asia will be very familiar with, as it's those sort of little stores on the sides that you can get your one pots in all over Asia. So again, just showing diversity of earnings, strong ability to grow their businesses, generating lots of free cash flow, and obviously in a very strong barriers to entry. So that's just a sort of a wrap up as to how we've been implementing the thoughts on what's been happening in the background into the portfolios. And I'll now hand you back to Trevor and the panel for questions. Thank you.
Thank you, Lewis. We lost you for a moment mid-Ellisor, I think, but I believe a lens maker, is that correct?
Ellisor, yeah, it's anything ophthalmic. So they make lenses, glasses, ophthalmic equipment, lots of brands, lots of licenses, predominantly known for Ray-Ban, Oakley, but they do also manufacture for other luxury branded goods.
Right, thank you. To welcome the panel, we have Carl Turner and Jamie Babsacklin from Infinity, two of our chartered financial planners. Harriet Collins, I think, will make an appearance there, from Tilney on the business development team, but also a qualified financial planner. And of course, Gareth's there to answer some of the questions. Now, interestingly enough, we usually get a huge amount of questions at this point through the Q&A. We don't have any today. So I think, Gareth, you've obviously been even more succinct than usual. Thank you very much. But we do have some questions that were posed earlier on. So really, this obviously was the theme of the presentation, but I'm going to ask it anyway, so you can summarize it. But this individual is asking your outlook on the economy for 2021 and moving into 2022.
That's for me, I take it.
I think so, yes.
Yeah, okay. Cool. Well, yeah, I think obviously we touched on it in the presentation, but not in too much detail. I think quite clearly 2021 is going to be a very strong year for global growth, linked very much to the expansionary policies being pursued by Biden. These come on top of what you would naturally expect, which is a rebound post-lockdown. Quite clearly, those people who've remained in employment have built up significant levels of savings. I think the suspicion for anyone who's been out and about since lockdown has even vaguely been lifted in the UK is that people are just going to go nuts when they're allowed out, and that there's going to be quite significant levels of personal consumption, which will boost economic activity. I think the longer run outcome is slightly less certain for two reasons. One, we don't know whether there'll be further mutations of the virus and how effective the rollouts will be for the inoculation programs globally rather than just in pockets of the world. And the second one is China, because China has been the mainstay of global economic expansion really since 2008, previous to that as well. But it is definitely now in a period of consolidation. The leadership are very aware that they have built up significant levels of debt excess in the system. They're trying to rein that in a sort of carefully orchestrated manner. And so what you're likely to see over the next 18 months to 2 years is US economic expansion continuing to grow under the Biden presidency. But that China will manage their economy much more carefully, and the two will probably offset one another. So while 2022 at the moment looks like a good year for global growth, we wouldn't expect it to be of the sort of explosive nature we're seeing at the moment, because what you're not going to have is a synchronized recovery. It's going to be a patchy recovery, and no more than that.
Okay, thank you very much. So one of the questions we're getting a lot from clients is, I've got money to invest, but the markets have grown so rapidly. Is it a dangerous time to be investing in equities? And from what you're saying, not quite yet.
Who is that one for me?
For you, Lewis, I think.
Well, I'll give the sort of general view, and then Lewis can be a bit more tactical. I think there's two things going on in the background that really make investing from cash so important. The first is rising inflation rates. I mean, the last 12 months with inflation rates at very low levels, particularly in the West, the opportunity cost of holding cash has been relatively small. But as inflation expectations grow, the opportunity cost of holding cash increases, because central banks are going to keep short rates, lending rates, very low for as long as they possibly can. The second general motivation for investment, particularly into equity, is that if people begin to become more concerned about embedded inflation, I'm not saying you'll see an aggressive sell-off in bonds, but you're likely to see quite a lot of rotation from bonds into equities, because the best way of protecting yourself from a rising inflation environment is to buy those assets that give you that protection. And a lot of that protection comes from investing in the right businesses, as Lewis explained, with sound balance sheets, good free cash flow, because that free cash flow gets returned back to you as a shareholder through a rising dividend. And if you can lock in dividend growth rates above the rate of inflation, you're protecting your capital. So I think there are some sort of structural reasons why equity markets will remain the default source of allocation, even in the current environment.
Thank you. And Lewis, did you want to add to that?
Yeah, thank you. I think from a sort of a more micro level, really, the one thing that we should remember is that when people talk about equities being expensive, what tends to happen is this sort of aggregation of equities. And the reality is that we want to disaggregate, because as I explained in the slide, we're not really looking to buy indices or sectors. What we're looking to buy is good quality businesses that have got sustainable free cash flow and the ability to return that capital to shareholders. And if we can keep our discipline and look through our data and sort of ignore some of those short-term nuances and the noise, but actually keep our mind on the long-term earnings growth of good quality companies, then actually it minimizes some of these sort of short-term effects that we're hearing in the news and optimizes our opportunity to invest for that longer term and get stronger returns. And therefore, that's why we look through our funds into the companies that we want to buy rather than just aggregating.
Great, thank you, Liz. And I think a follow-on question perhaps for Carl and Jamie on the financial planning side. When you're faced with clients who are looking to invest money, and obviously they are concerned perhaps the markets are, dare we say, top heavy, how do you approach that? What's your advice?
I think the way that I help clients reduce down the risk of investing into markets at the moment is really, reduce timing issues. So reduce that short-term volatility. So use dollar cost averaging or adding funds in over time. So we tend to move any new money into cash or really defensive portfolio, and then over time actually allocate those funds into the market or into their risk profile that they should be in over a 3 to 6 month time period. So that's how we sort of do it. So we move it into cash or into a defensive portfolio and then drip feed the money in slowly to reduce down time in the markets.
Great, thank you. I think, Jamie, this one, perhaps you and I think Harriet's probably got some opinions on, which is an interesting topic, which is that ESG has been a buzzword and certainly one of the winners of 2020. Do you think this is a passing fad or something that's going to continue? Maybe Jamie first.
Yeah, so obviously last year, ESG and socially responsible funds and environmental funds did very well. With a Biden presidency over Trump, I think that should probably continue. I think he's probably got a more realistic opinion of climate change than Trump may have had. So kind of going back into the Paris Accord and things like that, I think it definitely means it's not just a fad, and there's definitely going to be an opportunity. As everyone's been at home, everyone is trying to be more socially responsible, I think, globally, and that should then continue to see the growth in the sector. And I know Tilney are very hot on sustainability. I think Harriet can probably explain and expand a little bit on that one.
Yeah, thank you, Jamie. Yeah, absolutely. I mean, we don't see it as a fad at all, and have actually started to introduce the sustainability element into how we build the portfolios in general. So it's a core pillar for how we select fund managers and also how we select those investments that go into the portfolios to ensure they have sustainable aspects to them. So yeah, we see it's much more of a going forward feature. We've got the sustainable portfolios that we run already. I'm actually hoping to produce another one later in the year, which will be much more of a higher risk level. So definitely something that's there here to stay.
Great, thank you, guys. We've had a question come in from one of the attendees. Gareth or Lewis, I'll let you fight over it. What are your expectations for financial institutions like banks and insurers, both as businesses and therefore potential equity investments?
Do you want to go first, Lewis, or do you want to?
Yeah, I think if you do the sort of the background macro thing, I think that's probably wise. Yeah.
I mean, I think so. The banking sector is probably the easier one, and in truth, globally, it's by far the bigger sector. If you believe that we are going to see a shift in bond markets, that you're going to see higher inflation expectations, therefore an upward shift in medium and longer dated bond yields, then the prognosis for banks is actually very positive, because their fundamental business model is to borrow short. They borrow very short duration assets and then lend them out long, and the interest rate differential is effectively the margin they make. So one of the reasons why banks, particularly within the financial sector, have been rallying quite strongly in the last few months is because this perception of a steepening yield curve actually boosts banks' balance sheets. The thing, however, to be cognizant of is that not all banks are created equal, and that balance sheet strength itself, it has to be borne in mind. So if you look around the globe and you look at banking valuations, there's a clear distinction between those banks that really have cleaned up their balance sheets post the global financial crisis. They're largely, I have to say, in the US and the UK, and in parts of Asia, rather than in Europe, where frankly a lot of the banks in Europe really never took the opportunity to clean their balance sheets up effectively. So from a banking sector perspective, steeper yield curve, probably means greater profitability, means further re-rating, but on a selective basis. Lewis, anything you wanted to add to that?
Yeah, I think it's the selectivity bit that I wanted to just sort of pick out from there, really. I'm always wary as an investor when people talk about sectors specifically, because really when investors talk about sectors, what they're really talking about is what is the best performing equity in the sector. And then it becomes much more of that winner versus another winner or loser rather than the actual overarching sector. We've seen it in technology, we see it in household goods, and we see it in banking. So I think we always have to be cognizant of the risk of aggregation, as I said before, and it's just looking through at an individual level to those bank balance sheets that have got the strongest ability to grow, and also trying to look really underneath the bonnet sometimes because of the non-performing loans. And you haven't touched on that in this one before, but as we talked about on previous webinars, it's the non-performing loans that are the biggest drag to performance in the banking sector. So we want to be cognizant of what's in there as well.
Thank you, Lewis. And we are running out of time, so we're going to try and finish in a couple of minutes, but I think it would be remiss of us to close off a market outlook without bringing up one topic, the big bad B. So really, I think we'll get an opinion from the financial planners and from the investment management side on Bitcoin and its Ethereum and other sisters and brothers. It's the big topic. People have made a lot of money on it. But Jamie, Carl, what's your approach to your clients who are wanting to invest in Bitcoin?
Yeah, I'll go first, Carl. Yeah, it's definitely an interesting space. It's clearly not regulated and not something that we can actively advise on within client portfolios. I certainly have got some clients who do own some, and that's fine. It's entirely up to them. But in terms of what we're looking to do in terms of building a long-term sustainable portfolio for growth, then it's not something that we can actively advise on, and that's predominantly because it's not regulated and it's not within our investment universe. That's not to say that people can't buy it, because they can. It's just not something that we can advise on directly.
Yet,
exactly.
Carl.
Yeah, I think it's good for part of people's portfolios, but if you've got long-term financial goals and long-term planning, then it's more suitable to have as a bit of play money rather than your main bulk of your investment portfolio.
Got it, thank you. And to close that one, Lewis or Gareth?
Okay, well, I'll go first. I mean, I think there's two aspects. One is regulatory. So, as Jamie pointed out in his comments, I mean, we are not regulated. The FCA in the UK does not allow us to provide any advice or execute in any of the digital currencies. They are deemed to be too high risk by the regulator to be part of any private client portfolio. So we can't actually use them in portfolios even if we wanted to. That aside, I think the fundamental arguments for stores of value that move you away from the control of central banks is something that has got an appeal. If you think about what QE is and money printing and the debasement of paper currency, having something that represents store of value, whatever it may be, is an important part of anyone's long-term planning. So it could be a small investment in Bitcoin alongside other aspects of their portfolio, but it could be many other things as well. And I think while central banks continue to print money at the rate they are, then the attractions of these alternative stores of value will not go away, whether the regulator likes it or not. So, there's a very strong reason why people consider them. I'm not sure that people actually think about it that logically. I do think there's an element of it's gone up, it will continue to go up. One of the first things I was taught 30 odd years ago when I started in this industry is human beings have an immense capacity to extrapolate a short-term trend into a long-term one, and that's why people buy at the top and sell at the bottom. So I would just sound a word of caution that when people do buy these things, they're buying them because they want to protect themselves against currency debasement, not just because it's gone up from $10,000 to $60,000.
Gotcha.
And I'll just quickly add to that one just as well. If you are going to buy it, then do some research, listen to podcasts, understand what it is before you put your money into it. Don't just do it as a punt. It's the same as we wouldn't just put money into a random company that we've never heard of. If you want to do it, you need to try and understand what it is before you do that, rather than just buying it on a whim that maybe it goes up, because then you may as well just put it in roulette.
All good advice, I think. Lewis, did you want to say anything before we draw a
No,
line?
I would just not specifically about cryptocurrency. I just think it's really important that as investors we have an overarching discipline as to what we're aiming to achieve, and it is important to understand the different components of our portfolios and what they're all there to do. And as we know, equities generally are the best driver of returns we've talked about, especially from inflation protection. That's not to say then the other constituents then really act as a dampener to volatility. So if you're going to put something in that is extraordinarily volatile and is also very, very sort of a limited resource, then one should do so carefully, rather than, as Gareth says, it's just a case of it's shiny and it's bright and it's new and it's gone up lots, I should buy it. As we've seen over time, that is one of the fastest ways to actually lose capital, and our philosophy is about preservation of capital first, then growth. So, and I think if we stick to those disciplines, then actually we will not find people in a position down the track where they are having to work longer, unable to fund the retirement they wished, all the things that you as financial planners will have put into place previously.
Very diplomatically put, Lewis. So with that, I think we're at 5 minutes past the hour now. So really, I just want to thank the Tilney team, Lewis and Gareth, as usual, for a great presentation. Harriet, thank you for hosting. To Carl and Jamie, thank you for sitting on the panel. And to our attendees, thank you for taking the time to attend. There will be a video recording. You will get a link to it, so you can sit back and watch back at your leisure. We will be planning the next quarterly update, and likely it will be a webinar as well, considering current COVID conditions and travel. But thank you all for joining us. We really appreciate you taking the time. We hope you found it insightful. And if you do have any questions, feel free to email us, email your consultant, email me directly, and we will certainly get dialogues open. Thank you all very much and enjoy the rest of your day.
Thanks.
Thank you.
So
Thank you all.